Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
John, how are you doing?
Sam, I'm doing fantastically. Thank you for asking. And Sam, recently I was thinking about a conversation we had. One of our client advisors showed us the performance of another manager somewhere and compared it to the S&P 500, and the returns were just astronomical. I mean, just fantastic. Good for them. However, I didn't really have to take a look at the underlying holdings of the portfolio to know what they had done. And you and I talked about it and said, well, I guess they're overweight technology, and more importantly, overweight about maybe 5 to 10 names, if that.
Yeah.
And that would be pretty much the reason why they've underperformed over the last 12 to 36 months.
That's the story with most things, it seems like, this year. It's been a relatively simple storyline.
Yeah. Keep your money invested. Keep your money invested in the names that have worked terribly well, and you have done okay. Now, right now, when you take a look at the S&P 500 as a whole, 2 economic sectors and 10 individual companies comprise roughly 40% of the S&P 500. That's as of October 27th, 2025. Go straight to S&P, take a look at it. And this morning, and here I am talking on October 29th, I went and pulled some data, strangely enough, although I'm known to do such things, and I went to the SPY, Exchange Traded Fund. What is the S&P Exchange Trade ETF that tracks the S&P 500, one of the biggest ETFs in the world, if not the biggest ETF in the world. And I pulled down their holdings, took a look at their sector weightings, and the SPY is not a perfect proxy for the S&P 500, but it's pretty doggone close. And I'm just going to read off the data for this fund as of this morning on the website, October 29th, 2025. And they say information technology comprises 36.49% of the portfolio, financials 12.7%, consumer discretionary 10.3%, consumer communication services 10.3%, healthcare 8.9%, industrials 8.1%, consumer staples 4.7%, energy only 2.8%, utilities 2.4%, real estate 1.8%, and materials 1.7%. So information technology 36.5% according to S&P. And the SPY Exchange Traded Fund. There's a problem with that. And the problem with that is right now, Sam, companies like Amazon are classified, if I'm not mistaken, as consumer discretionary. Mm-hmm. And names like Apple and others are classified as communications, if I'm not mistaken. I think Apple, not Apple, but Meta.
Yeah.
Meta is classified as communication services. So if you reclassify stuff, and I went to Bloomberg to see how Bloomberg actually classified SPY, here is how Bloomberg classified the holdings in the SPI Exchange Traded Fund. It's a little bit different story. This is how they broke it out. Semiconductors, 15.2%, internet, 14.1%, software 11.0%, and computers 8.5%. Lots of numbers here this morning, Sam. But according to Bloomberg, taking a look at the SPY Exchange Traded Fund, a proxy for the S&P 500, total technology and communication services, really everything that you think of infotech, semiconductors, internet, software, computers, 48.7%.
Roughly half the market.
Roughly half the market is confined to, for all intents and purposes, I would say one broad economic sector. Sam, this is massive, massive concentration. Mm-hmm. How did we get here?
Well, the simple answer is it's been the talk of the market for years, and not just the talk just to talk about it. That's where the spending's been. That's where a lot of the growth has been. So there is reasons to it, and to me, this is just the latest storyline over. The market tends to move in these broad cycles.
Yeah.
Or, in my opinion, you get these themes that last for quite some time. Often, that's not abnormal for the market to grab onto these themes and last for quite a while. And this is the theme and the focus of the market right now.
Well, the theme and the focus of the market is certainly in technology, certainly in communication services, and certainly in artificial intelligence. Now, I've got to make a little caveat right now. Sam always loves to make caveats. The names I'm about to read out, individual names, We own all of them here at Oakworth Capital Bank across our platform in some form or fashion. And I will tell you that they're not necessarily huge holders of all of them, but we do all open client accounts. However, we are not a market maker of any stock at any time whatsoever. And what I'm about to relay is not really commentary on the companies themselves, just what their weights in the SPY is, what their weights in the what the sector is. And I'm going to read off really the top 10 holdings plus one in the SPY as of October 29. NVIDIA, 8.6%, Microsoft 6.8%, Apple 6.8%, Amazon 3.8%, Broadcom 3.1%, Meta Platforms, also known as Facebook to you old fogies, 2.8%, Alphabet, also known as Google to you old fogies, 2.7%, and that's Alphabet Class A shares.
So half of it.
Yeah, half of it. Tesla, 2.2%. Now Alphabet Class C shares, 2.2%, and then Berkshire Hathaway, 1.5%. Those are the top 5 holdings. However, Sam, there's 2 holdings for the same company, right?
So that make up total 4.9%.
So that's a total. Those are 9 individual companies, 10 individual securities. Make sense?
Yep.
So if we take a look at the next company, that's J.P. Morgan at 1.43% of the SPY as of this morning. That means 10 companies alone make up 41.9% of the SPY, which again is a proxy for the S&P 500. Sam, it's pretty fair to say how goes this fistful of companies is kind of how goes the markets. And interestingly enough, back in the day, back when I was involved in the administration and management of mutual funds and mutual fund family, there were these buckets. In order to have a in order to have a diversified portfolio according to SEC registrations, you had something called a bucket. You couldn't own stocks that constituted more than 5% of the portfolio combined. You add all those up; those couldn't make up more than 25% of the portfolio. Catch my drift?
Yeah.
So you couldn't have, say, 4 stocks that represent, they each with a 7% weight. Because that would be 28% of the portfolio, then you would fail. You would no longer be a diversified portfolio. You would have to classify your portfolio as non-diversified. It's nerdy stuff. Mm-hmm. I'm a nerd. And so
it is getting into the
that's
weeds.
Getting into the weeds. I tell you that because, ladies and gentlemen, boys and girls of all ages, we're not that far away from just good old-fashioned S&P index funds being technically non-diversified portfolios. Mm-hmm. Not there yet. We're still barely falling underneath that bucket if that rule's still in place. I have no reason to think that it isn't. So it's pretty fair to say how goes a fistful of names in the huge U.S. economy. Fistful of names is how goes your investment portfolio, at least over the last 12, 24, and 36 months.
Well, that's just the math of it, right? It's if you see some of these extremely large companies move a few percentage points, that's very easily hundreds of billions of dollars in market cap. And so,
what is NVIDIA now, like $5 trillion?
Yeah, it crossed over $5 trillion recently. So small moves, percentage-wise, are big moves in market capitalization.
Yes.
And so just mathematically speaking, it becomes easier and easier for one name or handful of names to offset a large swath of other names within an index, using the S&P 500 index as an example. And so we've started to see it. We've seen days where most names in the S&P are down and the S&P 500 is up for the day. And again, it makes sense when you look at the weightings of it and how little of a percentage move it could take in a few names to offset really everything else. We saw it, I believe it was Monday, one of the days earlier this week, where it's the worst breadth since I could track it in the 1990s, where over 380 names in the S&P 500 were down and the S&P was up. So that's breadth is a term talked about a lot. That's how widespread is a movement, right? You tend to want to see a lot of names contributing to it. But
listen, on a day that the market's up, you'd love to see 500 names be up.
Yeah.
Not 10 names be up and everything else sideways or down.
Yeah.
Because that's not truly indicative, in my estimation, of the true health of the U.S. economy. And so, but you're right, you kind of touched on it. Investors love sizzle. They love it. Sizzle often sells. And so I don't think there's anyone out there that would debate that AI is really cool. I don't think anyone's out there that would debate that the advancements we have made in technology just in general, really this century, but really increasingly over the last 5 years, it's astronomical, it's exponential, whatever adjective you want to throw at it. So of course that is where the absolute growth is going to be, or that's what it seems. It would seem as though that's where the growth is going to be. And so investors want to plow into where they think the growth is going to be. They want to skate to where the puck is going to be, not where it is. And so when the money flows in, stocks go up, and then you get this virtuous, if you want to call it that, cycle, sort of a fear of missing out sort of type deal, until you get to a point where all of a sudden you get to where technology is close to 50% of the overall index, to where names, the top 5 names in the index make up what? Close to 30% of the overall index. And intuitively speaking, that's not necessarily truly indicative of the U.S. economy as a whole. Is it?
I don't think it is, but when we're talking about AI, I believe that part of the issue when people are having this conversation of how impactful AI is that very often people are talking about two different things with AI. And I think I fall into what tends to be the less tech savvy bucket, and people, when they see AI, think of how a ChatGPT or an Anthropic or Claude or one of these is replacing your Google searches, which is how a lot of people are using it. Instead of going to Google to search something, they're plugging in ChatGPT. That is not how AI is changing things. It is not through replacing search. And so that, it seems like the conversation has diverged between two groups of people saying AI is going to change everything and AI is impactful, but it's not going to change it in the near future. To me, it seems like those people in the latter half are viewing it as a search replacement, which it is. To me, it is not, even though that's frankly how I use it. But to me, to answer your question, though, I don't think this is indicative of the overall economy necessarily, and I don't think the stock market as a whole is necessarily indicative of the overall economy. Yeah. I mean, depending on which measurement or study you want to look at, on average, only about 1 in 5 people employed in the U.S. work for publicly traded companies.
Yes.
That, I mean, almost by definition, is not the overall economy. Is how publicly traded.
Yeah.
You know, if every publicly traded company went bankrupt and fired everybody, I mean, again,
assuming there are no multiplier effects and all that stuff.
In a vacuum, 80% of employees are still employed. Yeah. That's not the overall economy.
That's not what you're predicting, are you?
I'm not predicting.
Okay, good. I will tell you though, taking a step back to what Sam was talking about, he's the type of person that might view AI as being just a replacement for Google searches and what have you. I'm of the different camp. I view AI as replacing jobs and doing all kinds of stuff. As a matter of fact, to those of you listening right now, I'm not even talking right now. Sam's not talking. These are our avatars talking. I'll let you think about that one for a second. In all seriousness, though, at some point that's probably going to be the case.
I think it could already
at some point that's going to be the case. And I told my son John, who is soon to be 24, I guess I need to, by soon to be 24, I'm talking about in 2 weeks. I need to go out and, get him a gift, but that's beside the point. I was talking to him one time about AI, and I said, John, it's really cool. I said, your great-grandchildren could be able to, or might be able to see me make an economic presentation, or actually hear a podcast that I generate. He goes, no, the guy said, yeah, it's really cool, assuming that people 100 years from now want to hear the sound of my voice, or I think I add enough value to it, which they won't. But even so, that's out there. It's pretty cool. So, I don't think there's anyone out there that would debate that AI and all the associated technologies and all the technology that we've had recently, I don't think anyone would debate that it is forever going to change how we conduct our lives and how we conduct business, how we run our lives and conduct business. These things are game changers. They're economic game changers. They're personal game changers, not unlike the Industrial Revolution, not unlike the Internet. And so when you see stuff like this, people want in on it. But as we found with the tech bubble back in 2000, 2001, and 2002, just because the technology might be the growth engine for the future doesn't always necessarily mean that they're going to be a good investment at any one given time. Correct?
Absolutely.
And so
we could point to 1,000 examples across
point to 1,000 examples.
1,000 themes. And
well, listen, I like tulips. You know where I'm going with that?
I do know where you're
well,
going.
Of course, if you listen to economic podcasts, you probably know the old tulip mania back in the 1600s in Holland. We still have tulips, and while
the railroads in the UK,
without a doubt, and that's a perfect example. I think the internet's a great example.
Retail in the 60s with the population boom.
Utilities in the early part of the 20th century, all of
Yeah.
it. And so steel companies, I mean, Bethlehem Steel, U.S. Steel,
that
all that
was-
stuff. I mean, at one point there have always been companies that make up a disproportionate share of the overall stock market. That's where the growth is. But, this time, right now it's technology, it's AI, it's going to change our lives. There's going to be something out there in the future that's something else. I mean, maybe we revert back to the managed utilities. Yeah, I don't know. I mean, I can't look into the future with crystal clarity, otherwise I wouldn't be doing this, right? So when you take a look at that type of thing, it's kind of like, this is really cool. It doesn't mean that it's always going to be the case, and at some point, this will cool down. And you got to be very careful about this stuff. I guess I've got to use a weaker verb and say it should or could or probably will cool down at some point, because right now people are buying growth. Right? And that's what people were buying in the dot-com bubble. They were buying growth. So I'm just going to give this example. Assume there's a company that's going to spend, I'm throwing numbers out here, straw man, this is not a specific example of any one individual company. So suppose Company X. You like Company X?
Oh, yeah,
Yeah,
sure.
man, they make widgets. Let's say they spend $10 billion. They spent $10 billion on AI and technology last year. $10 billion. A lot of money, right? This year they spent $20 billion on it, right? That's huge. That's 100% gain. Well, next year they're planning on spending $30 billion. They're still spending a ton, right? But that growth rate's gone from 100% down to 50%, right? And so the year after that, they're going to spend $35 billion on AI and tech. That's still an enormous amount of money, but the growth rates have gone from 100% down to 50%, down to, what is that? I mean, 15%, roughly 20%. So you're seeing the growth rate slow, even as the absolute investment is enormous. And then you start having investors going, okay, growth rates have cooled, earnings have cooled as a result. Maybe I'll take my marbles and go on to something else. And that's we've kind of seen that happen in the past. So it's a question to me of not if this is going to happen, but when, and I don't know.
But that's what markets do, right?
Yes.
I mean, this isn't unique. It's not unique to 2000. Again, we pointed to examples. Tulips maybe not as much because it's just a pure speculative bubble. But the railroads. If you've read about the railroads in the UK and the fervor over that in that time period and what
and
was
for good reason. I mean, my lord.
But retailers, I mean, with this population boom, there is always
Or automobiles after World War II.
there are themes that drive markets. Always, there is always going to be a theme that drives markets. That is not unique to now. It's not unique to 2000. That is always going to be the case.
Without a doubt.
And so, you're just, again, it goes back to what are you paying for? Because these companies are going to change it, but what sort of expectations are priced in? That's the end of the day for any investment, though, right? Is your expectation for something, if you're going to buy it, is that things are going to be greater than what the population as a whole is priced into.
Yes. So when you take a look at that, and this is the story right now. Tech is, more importantly, AI within tech, but everything seems to be connected right now in a lot of ways. What does this all mean for the future return of the U.S. stock market? I mean, can this go on forever? And if it can't, what's coming next? I mean, what's down the pike? Understand, we can't look into the future with crystal clarity, and any actions that you take based on anything you hear are based on, I mean, that's at your own risk.
Look, I'll answer it with just the math of it and take my opinion out of it. If you believe that this trend is going to continue as it has, you believe that this concentration in certain areas of the market is going to become a bigger and bigger
Yes.
and bigger. That for it to outperform, that's the math of it.
By definition.
Outperformance
By definition.
would mean that it becomes a bigger chunk.
Yeah.
So that 48.7% across those four techie sectors of the market becomes bigger if it continues to outperform.
It means-
so that's what you are. That to me,
That's the bet you're making.
so yeah, I'm not even going to say my opinion on that because there's lots of people who do. There's lots of people who don't. To me, that doesn't really matter. That's why you make personal decisions on where you're investing in. But that's what it is. This is going to become a bigger portion of the market.
Yeah, and there's probably someone out there screaming, saying Sam doesn't get it. It's where the profits are, not necessarily where the overall economic activity is, and we get that and all that stuff. And I would say ultimately over time the two will converge. In the short term, profits might be greater than the overall economic activity, but over time the two converge. And so I hear you on that. And Sam, I mean, kind of along the lines of what you're saying, and you're absolutely right on that. In order for this to continue the way that it has for the last 12 months, last 24 months, last 36 months, we would have to be sitting there saying, instead of total technology making up 48.7% or thereabouts of the market, according to Bloomberg this morning, next year it might be 50. The year after that, it might be 52, it might be 53, 54, 55. Means that these sectors are going to have to continue to outperform everything else that happens in the U.S. economy for them to continue to outperform. That means if that applies, you're also making the bet that companies like NVIDIA make up greater than 8.6% of the market moving forward, and Microsoft and Apple greater than 6.8%, Amazon greater than 3.8%, and so on and so forth. And then we really do get to that diversification problem that I was alluding to earlier in terms of just SEC regulations for 1940 Act funds.
Yeah.
And so then we're going to have a real issue at hands, and we can start talking about how the S&P 500 is no longer diversified, and that's going to throw everyone into a lather because there are all kinds of documents out there saying portfolios need to be diversified and what have you. And maybe that's what ultimately caused things to become more diversified. It's just administration and regulations just about diversification and public portfolios. And you never know. But I will tell you this, that at some point we'll see a slowdown. It doesn't mean, everything I'm saying and we're saying here doesn't mean things have to fall apart.
Yeah.
It doesn't mean that all of a sudden these stocks are going to crater. I mean, these valuations have not gotten ridiculous like they were at the end of the dot-com bubble with some of these things. These companies are generating real profits.
Yeah, earnings has gone up while the market's gone up.
This isn't the same as the dot-com where you had companies that weren't generating any profits and people were throwing money into them and faulty business plans. Companies that we've mentioned, every name that we've mentioned, I mean, they're making money. Yeah, I mean, these are real companies with real revenue and real profits. Yeah, so it's a little bit different story in that regard. However, for me, the way I view the world, and I think the way a lot